Australia's largest healthcare company did not just fall today, it erased a decade of gains in a single session. CSL shed more than 18% after interim CEO Gordon Naylor completed his 90-day review and delivered numbers that invalidated years of investor assumptions. The share price hit an 11-year low, and for anyone still holding, the question is not what went wrong, but whether the valuation case has changed structurally. The mechanism behind the collapse runs deeper than one bad quarter. In U.S. immunoglobulin, CSL's core revenue engine, channel inventory normalization is expected to cost the company roughly $300 million in fiscal year 2026. That is not a demand problem. End market growth is still running at mid to high single digits. But distributors overstocked during the post-COVID recovery, and that excess is now flowing back through the system, compressing CSL's top line even as underlying patient demand holds. In China, albumin volumes have stabilized after market share gains, yet the price per unit has fallen sharply, adding another $200 million headwind. The Middle East conflict, slower than forecast Hemgenex uptake, and iron competition compound the damage for a combined $150 million more. Together, these three unrelated pressure sources converged in the same reporting window, which is why the market reacted as if the business model itself had broken. The impairment announcement sharpened that read. CSL flagged approximately $5 billion of additional non-cash pre-tax write-downs across FY26 and FY27, layered on top of the $1.5 billion already booked in the first half. The bulk targets CSL Vifor's intangible assets, the portfolio acquired in the 2022 Vifor merger, that management once described as the company's next growth platform. Writing down that asset to this degree signals that the strategic thesis behind the acquisition has not materialized on the timeline the market was pricing. Annual revenue guidance now sits at approximately $15.2 billion on a constant currency basis, down from $15.6 billion in FY25. NPATA is guided at approximately $3.1 billion versus $3.3 billion last year. For a company trading at a premium to the broader ASX index based on expected double-digit compounding, a year of earnings regression resets the multiple entirely. The question that the impairment does not resolve is whether the earnings base at $3.1 billion is the trough, or whether further resets remain. Management targets $500 to $550 million in annual transformation savings by FY28, but the market has now heard multiple guidance cuts and will demand evidence in reported numbers before crediting forward targets. Until FY26 closes and the restructuring charge is fully recognized, CSL's true floor remains unknown, and that uncertainty is precisely why today's selling was so aggressive. What the CSL collapse overshadowed was a set of fiscal policy changes arriving Tuesday that carry their own structural implications for ASX capital allocation. The Chalmers budget is expected to remove negative gearing concessions on established residential properties and alter the capital gains tax discount framework simultaneously. UBS has described this combination as the most consequential federal budget for the Australian share market in years. The transmission from housing tax to equities is not direct, but the capital flow logic is specific. Negative gearing currently allows roughly 1.1 million Australian investors to deduct losses on investment properties against ordinary income. Approximately 700,000 of those investors hold established homes, the category that loses the concession. When the tax incentive to hold a loss-making property disappears, those investors face a binary choice: sell or restructure. Property advisors are already framing the expected outcome as a rotation from retail landlords toward institutional capital, following the U.S. model where private equity funds absorb the supply when individual investor activity contracted. If institutional super funds step in, as Treasurer Chalmers has explicitly encouraged, the capital does not flow into equities. It rotates within alternative assets, and equity risk appetites among retail investors shift. The CGT discount change compounds this. Under the current 50% discount regime, an ETF investor earning 10.3% annually on a $100,000 portfolio retains 8.7% after tax over 10 years. Under the proposed inflation indexation replacement, that figure falls to 7.4%. The after-tax wealth difference on that single position reaches approximately $25,844. For property investors, the gap is larger. For startup founders, larger still. The relevant capital flow implication is not whether investors feel poorer on paper. It is whether the after-tax differential between equities, property, and cash narrows enough to shift marginal allocation decisions. UBS research argues that high price-to-earnings growth stocks, the healthcare and technology names that dominate institutional portfolios, face disproportionate selling pressure when after-tax growth returns compress, while banks and real estate businesses, which trade on yield rather than earnings growth expectations, become relatively more attractive. That rotation logic lands on an ASX that was already under pressure from the CSL collapse and oil-driven inflation fears. The RBA's decision to lift the cash rate by 25 basis points, confirmed this week, raises the discount rate applied to long-duration growth assets exactly when the budget is removing the tax incentives that historically sustained retail participation in those names. Both forces point in the same direction, but neither on its own would be sufficient to shift sector weights materially. Together, they create a structural repricing condition, one where the question is not whether growth sectors face pressure, but how much of that pressure is already in current prices.
Running underneath both the CSL story and the budget debate is an oil shock that neither can fully absorb. Brent crude crossed $101 per barrel on Monday after President Trump publicly described Iran's peace conditions as totally unacceptable, reversing a brief ceasefire optimism that had driven a 7% crude decline last week. The reversal was fast and directionally decisive. Energy stocks on the ASX were the single outperforming sector on a day that saw healthcare lose 6.5% and financials fall 0.7%. The Iran war's impact on Australia runs through two channels, and they operate on different timelines. The first is commodity price. Brent at 101 means Australian energy producers like Woodside Energy earn more per barrel sold, supporting the ASX Energy Index even as the broader market falls. The second is inflation persistence. Super ratings data confirm that the median balance superannuation option returned 2.6% in April, recovering most of March's 3.2% loss on expectations of a ceasefire. With those expectations now in reverse, the inflation persistence question running underneath both the CSL story and the budget debate is an oil shock that neither can fully absorb. Brent crude crossed $101 per barrel on Monday after President Trump publicly described Iran's peace conditions as totally unacceptable, reversing a brief ceasefire optimism that had driven a 7% crude decline last week. The reversal was fast and directionally decisive. Energy stocks on the ASX were the single outperforming sector on a day that saw healthcare lose 6.5% and financials fall 0.7%. The Iran war's impact on Australia runs through two channels, and they operate on different timelines. The first is commodity price. Brent at 101 means Australian energy producers like Woodside Energy earn more per barrel sold, supporting the ASX Energy Index even as the broader market falls. The second is inflation persistence. Super ratings data confirm that the median balance superannuation option returned 2.6% in April, recovering most of March's 3.2% loss on expectations of a ceasefire. With those expectations now in reverse, the inflation persistence question reopens. The RBA already lifted rates this week in response to inflationary pressures the Iran conflict had injected into global supply chains. If the Strait of Hormuz situation escalates further, the next RBA decision faces an oil price path that makes early rate cuts harder to justify. Citi maintains a 3-month Brent forecast of $120 per barrel, implying roughly 19% further upside from current levels if the US-Iran deadlock holds. At that price, Australian motorists face another fuel cost shock, household discretionary spending contracts, and the retail sector's recovery thesis stalls. That is the condition where the CSL impairment, the budget tax reform, and the oil price shock stop being three separate stories and become a single capital allocation crisis. Growth stocks repriced by tax policy, yield stocks pressured by rising rates, and consumer discretionary stocks hit by energy costs. The one sector that benefits in each scenario is energy. The verification condition is specific. If Brent holds above 100 through the end of May, the RBA's June meeting becomes contested, and the growth to yield sector rotation that UBS projected from the budget will accelerate without a policy offset. If a credible US-Iran ceasefire materializes and Brent retraces toward $85, the level that prevailed before March's escalation, the inflation pressure eases, the rate path becomes more flexible, and CSL's self-described recovery trajectory and bearing second-half revenue growth becomes the dominant read again. The leaning given today's evidence tilts toward the former. Oil staying elevated is the base case when Trump's public posture hardens, not softens. But CSL at a decade low with a known earnings trough at US $3.1 billion offers a recovery scenario that becomes investable the moment the oil variable stabilizes, which is precisely the condition worth watching. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.